In the world of investments, stocks, bonds, and derivatives are some of the most commonly traded financial instruments. Each plays a unique role in the investment landscape, offering different opportunities and risks to investors. Understanding the key differences between these investment vehicles is essential for making informed decisions and diversifying one's portfolio. In this video, we explore the top 10 differences between stocks, bonds, and derivatives. 1. Definition. Stocks represent ownership in a company. When you buy a stock, you acquire a share of the company, which entitles you to a portion of its profits, dividends, and gives you voting rights at shareholder meetings. Bonds are debt instruments issued by governments, municipalities, or corporations. When you buy a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount when the bond matures. Derivatives are financial contracts whose value is derived from the performance of an underlying asset, index, or rate. Common types of derivatives include options, futures, and swaps. These contracts allow investors to speculate on the future price movements of assets without directly owning the assets. 2. Ownership versus lending. When you invest in stocks, you become an owner of the company, with a stake in its performance. The value of your investment rises and falls based on the company's success. Bonds do not confer ownership but instead make you a creditor to the issuer. As a bondholder, you're entitled to receive regular interest payments and get your principal back at maturity, assuming the issuer doesn't default. In derivatives, you don't own the underlying asset. Instead, you're entering into a contract to buy or sell the asset at a future date, based on agreed-upon terms. 3. Income generation. Stocks provide income primarily through dividends, which are paid out by companies from their profits. However, not all stocks pay dividends, and the income from stocks is often variable, depending on the company's financial health and market conditions. Bonds generate income through interest payments, also known as the coupon. These payments are usually fixed and paid at regular intervals, offering a predictable income stream for investors. Derivatives do not inherently generate income. However, some derivative contracts, such as options and futures, can yield profits based on price movements of the underlying asset. The income generated depends on market speculation and timing, making it riskier and less predictable. 4. Risk level. Stocks are typically considered riskier than bonds because their value can fluctuate significantly based on market conditions, company performance, and external factors. However, they also offer higher potential returns over the long term. Bonds are generally seen as lower risk investments compared to stocks, especially government bonds. Bondholders are paid before shareholders if the issuer faces financial difficulties, making bonds a safer bet for conservative investors. However, bonds still carry risks, such as credit risk, interest rate risk, and inflation risk. Derivatives are the riskiest among these financial instruments due to their speculative nature. Because they are leveraged products, small price movements in the underlying asset can result in large gains or losses. Derivatives are often used for hedging or speculative purposes, and their complexity adds to the risk. 5. Liquidity. Stocks are highly liquid, meaning they can be quickly bought or sold in the market without significant price changes. Most stocks are traded on public exchanges, making them accessible to investors. Bonds can be less liquid, especially if they are not traded on major exchanges. Corporate bonds and municipal bonds may be harder to sell quickly without affecting the price. Government bonds tend to be more liquid than corporate or municipal bonds. Derivatives can vary in liquidity. Exchange-traded derivatives, like futures and options, are typically more liquid than over-the-counter, OTC, derivatives, which are custom contracts traded between two parties. Liquidity can be a concern with more complex or illiquid derivatives. 6. Purpose and use. Stocks are primarily used by investors who are looking for capital appreciation, long-term growth, and the potential for dividends. Investors buy stocks to gain a share in a company's profits and success. Bonds are typically used by investors seeking income stability and lower risk. They are often chosen by those who want to preserve capital while earning predictable returns from interest payments. Derivatives are often used for hedging against risk or speculation. Investors use derivatives to protect their portfolios from price fluctuations in assets or to profit from anticipated price changes in assets without owning the underlying asset. 7. Maturity. Stocks do not have a maturity date. Investors can hold stocks for as long as they wish, and there is no obligation for the company to buy back the shares. Bonds have a fixed maturity date, at which point the principal amount, the face value of the bond, is returned to the bondholder. The bondholder also receives interest payments until maturity. Derivatives typically have an expiration or settlement date, at which point the contract is either settled or rolled over. The time frame of a derivative depends on the specific contract and the underlying asset. 8. Regulation. Stocks are heavily regulated by government bodies, such as the Securities and Exchange Commission, SEC. In the U.S., companies that issue stocks must comply with disclosure requirements to ensure transparency for investors. Bonds are also regulated, but to a lesser extent. Government bonds are subject to regulations from entities like the U.S. Department of Treasury, while corporate bonds are overseen by the SEC. However, bond markets are generally less regulated than stock markets. Derivatives are regulated by both national and international bodies, including the Commodity Futures Trading Commission, CFTC. In the U.S., derivatives markets are complex, and while they are regulated, some over-the-counter, OTC, derivatives may not be subject to the same level of scrutiny as exchange-traded derivatives. 9. Volatility. Stocks can be highly volatile, especially in short-term markets. Stock prices can fluctuate significantly due to company performance, market sentiment, or external factors such as economic conditions or geopolitical events. Bonds are generally less volatile than stocks, particularly government bonds. However, they can still experience price fluctuations due to interest rate changes, credit rating adjustments, and changes in inflation expectations. Derivatives are typically more volatile than stocks and bonds due to their leverage. Small price movements in the underlying asset can result in significant changes in the value of the derivative contract, amplifying both potential gains and losses. 10. Return potential. Stocks have the highest return potential over the long term. While stocks are volatile, they can offer substantial capital appreciation, especially for growth companies. Historically, stocks have outperformed bonds and other assets in terms of long-term returns. Bonds tend to offer more stable but lower returns compared to stocks. The return from bonds comes mainly from interest payments, and the price appreciation is limited, especially for government bonds. Derivatives can offer the highest return potential, but they also come with significant risks. Since derivatives can be leveraged, the potential for profit or loss is amplified, which makes them attractive for speculative traders looking to capitalize on price movements. Understanding the differences between stocks, bonds, and derivatives is crucial for making informed investment decisions. Stocks offer ownership and growth potential but come with higher volatility. Bonds provide steady income and lower risk but have limited return potential. Derivatives, while offering high return potential, are the most complex and speculative, requiring careful risk management. Each of these instruments serves a different purpose in an investor's portfolio, and understanding their characteristics helps investors achieve a balanced and diversified investment strategy.